All right, what's up, folks? This is Ferris Sleem, the editor of the Bowser Report, the penny stock investing newsletter. Today, we're going to be going over another educational topic. We will be talking about the best strategy for buying the dip in the stock market. Okay, now, to be clear, this strategy is not aimed towards nailing a low or timing the stock market, right? Because your goal as a long-term investor is not really to nail a bottom or nail a top. That is a pretty unrealistic goal, and on top of that, you're going to lose a lot of money trying to do that. So this is mainly going to be aimed towards how you should think about managing your portfolio and how I manage my portfolio and how we do it at the Bowser Report when the markets start pulling back. Now, first things first, we have to define what a dip is, right? Because this is already a gray area here where if we're looking at, the S&P 500 or the Dow, which is a pretty useless index to look at, or the Russell 2000, right? These are all going to differ big time. And really, this should be the easiest part of it, right? Saying that this is a sufficient pullback, I can start buying some of my favorite stocks at a discount, right? That's the goal. Get some discounted shares, buy them at a good price, hold them in the long run. So defining a dip is actually pretty simple. Typically, it's a 10% plus pullback, but that doesn't always happen, right? Lately, the markets have been more volatile, especially, starting last March because of COVID. So 10% plus dips have been more common, but in a normal bull market, it's usually a 5 to 10% pullback, okay? Now, you don't need to be running the numbers all the time. It's blatantly obvious when we do have a dip, but one good way of doing it, and I'll show you a quick trick here, is just by using the volatility index, all right? So I might have lost you there for a second, but it's a pretty simple aspect of investing, right? When the stock market starts going down rapidly, volatility goes up, okay? They go hand in hand. Now, notice I said rapidly, right? Volatility usually ramps up a lot faster when the markets drop down a lot faster, but in this Thinkorswim platform, right, from TD Ameritrade, you can use any charting platform you want. The basic way to constitute a dip for me is when the volatility index pops back above 30 bucks. Simple as that. So the ticker is VIX if you want to look up the symbol. This is just an easy way for new guys to understand it, right? Obviously, more experienced investors are watching the markets more actively, but not everybody has time to do that. And more importantly, all you got to do for the volatility index is just set an alert, right? You just set a price alert, wait for it to get above 30, and that typically constitutes a dip. Now, you will have to check the S&P 500 after this just to double check that everything has pulled back sufficiently, but volatility spiking over 30 bucks is normally a sign that the markets have either corrected or they're close to correcting. Okay, now corrections are exactly that, right? We're pulling back in a strong trend, so our goal is to get discounted shares, right? Now, if you want to set a price alert in pretty much any platform, just to make sure everybody knows how to do this, almost every platform lets you just right-click the chart. And then you go down to create alert, which I think is a little bit out of vision here. Let me do it up here. Yeah, create alert. And then all you got to do, set the price point. So for me, I'm going to put 30 at or above. And I could just say market's dipping, market's dropping, whatever, and then create that alert. And you could see that if the volatility index, VIX, gets above 30 bucks, I know the markets have pulled back. Okay. Now, that's a really simple way to do it, but now we need to talk about your actual action, right? When you're pulling the trigger, when you're having that confidence to buy. Now, basically, the way that we've looked at it so far is that if the markets pull back 5 to 10%, we're loading up some of our favorite names. So in order to actually understand what your favorite names are, you do have to do a little bit of research. Most people already know this, right? Off the top of my head, I know what my favorite small caps are. I know what my favorite large caps are. I have a very diverse portfolio, but typically for the Bowser Report, we go for at least 8 tickers in our portfolio, right? And we try not to have more than 12 to 15. It's not a big deal if you do, right? Diversification is a good thing. But for the most part, we want to have about 8, 12 holdings. and keep it nice and simple. So out of those 8 to 12, you should already know what your favorites are and really what's an appealing price point. Like if I were to tell you, for example, let's just use a large cap that everybody knows. If I were to tell you that Amazon came down to $2,000, if you're a long-term investor, you should know, whether or not that's something that you would want to buy, right? So it's the same thing for penny stocks. All you got to do is make a list of your favorites, right? So for me, this is usually 1 to 3 stocks. You don't need to load the boat on every single dip and overexpose yourself. You just want to buy some size in some of your favorites. So let's just go with a standard list here. Let's just go with 2, right? 2 Bowser Report stocks that I like in terms of upside potential, and their fundamentals are RADA, which you guys are probably familiar with. It's been on a crazy run in the past year. And then LSYN, okay, Liberated Syndication. This company, RADA, just to give you guys a brief analysis, has really solid growth, okay, very strong growth, and is expanding into a lot of different markets, right? And they're landing huge deals. They have great contract momentum. It's your typical growth stock, right? We recommended it, I think, $1.80, something like that, and it hit $13 this year so far because small caps just lit up. Liberated Syndication, this one I kind of like the podcast angle, right? Podcasts are becoming a part of everyday life now. This is one of the market leaders, and it's publicly traded, and it's got good financials. So those 2 off the top of my head, I can make a list and say, you know what, I like these 2. Let me look at what would be a good price point for them. Now, again, it seems like a long process. We're already 7 minutes in. We've talked about, how to spot volatility in the markets, how to know that that's a dip, and what kind of favorites you want to set aside for a market pullback, right? But more importantly, you need to be able to distinguish between growth and value, right? Value stocks weren't really relevant till about a month ago. They've been getting absolutely crushed. And then recently, when the S&P was hitting a new high about a month ago, growth stocks took a beating and we saw some money rotate into value. So value stocks are still pretty relevant, but just categorizing my favorite list, right? I can tell that this is a growth stock based off of their revenue growth, right? This is also a very clear growth stock based off the revenue growth. So for me, I'm not going to try to buy around the company's value, right? That's how you would approach this with a value stock. With a value stock, it's very realistic that you're going to get the company's book value or under book value when you're buying into it, right? And that's pretty much saying that you're not overpaying for what that company's worth. For a growth stock, you're usually paying a premium, right? Where you're not going to get 50 cents a share, but $3 a share is not bad relative to its competitors, right? So for those 2 stocks, RADA and LSYN, I know what the good price is based off of the relative price to its competitors, but also based off of what it's been trading at lately. For value stocks, I'm always going to look at the book value, okay, PE ratio, price to sales ratio, these kinds of metrics in order to gauge what is a good price. Normally, it's just under the book value, okay? But since we're dealing with 2 growth stocks, that makes our life a little bit easier. And we can take it back to the chart real quick. Again, you don't need to have knowledge of charts to do this. These are very basic charts in Thinkorswim. Okay. So we can switch this over to LSYN. This is a pretty standard chart. And again, these are candlesticks on the chart, but you don't really need to understand that. If you're a basic investor that's just getting started or you just use fundamentals, that's okay, because this is the same thing as a line chart, basically. Right? Just shows you a little more sequencing. But for the most part, on this chart, this is the price over the past year, right? It's the daily time frame. So this is the past year of price action. Each candle here representing a day of trading. So for LSYN, we could see that over the past year, it's ran up from 240. This is a really skewed chart, by the way, because we had the COVID crash right before this. 240 all the way to 570. Okay. Now for me, just from a basic fundamental perspective, if a stock is down 50% from its 52-week high and I like the company, I should be more than willing to buy it, right? That's a really simple rule of thumb. Now, the way I do this, and it's kind of a basic math type deal, I just take the difference between the 52-week high and the 52-week low, and then I take a third of that. So here's the math behind it. We can even just round this, right? 5.8 minus 2.4, not really the hardest math, 3.4. Okay, so $3.40 is the difference between the low and the high. So what I do is I just divide that by 3. And if the stock has pulled back that much off the high, then I'm willing to add some size to it. Okay, now you can be more strict. Basically, the lower that this number is, the more strict you're being, right? Because what this means is that, 580 minus a third of this, which is about 1.1. Okay, so it's $3.40 difference. And that's divided by 3. It's about 1.1, okay, per share. So that means if this stock drops $1.10 from the high, I should be willing to add some size to this position, and I can buy the dip. Okay. Now the point is, and this is the strategy, this is the kicker right here, most important part of the video. The point is not to buy a dip in general for this stock. The point is to buy a dip in a stock that is simply correlating with the stock market, right? Because what you're doing when you do that is you're catching an imbalance, right? There's an unusual market occurrence where your stock is still making money, right? The company is still doing very well, but just because the market conditions have kind of just been tabled, right? It's kind of just cooled down, we're able to now get a discount on these shares for virtually no reason, right? Because LSYN is not being affected by economic conditions that much, right? It's all making money. It's all about making money online, right? So in this case specifically, I would just go 570 minus $1.10. That means 460 and below, I'm willing to add some size. All right, so far what we've gone over, and I want to simplify this moving forward a little bit. We've gone over how to identify the dip, right? You can even just use the 10% mark and say, oh, if markets have dropped down 10%, that's a good reference point, right? Or if you want to take the CNBC approach, when Kramer's telling you to sell, buy, right? There you go. The other side of this, what we talked about was making a list of your favorites, okay? And for me, we just went over 2 stocks. LSYN, we'll go over Rata in a second. After that, you just use that simple math trick, right? 52-week high minus the 52-week low, and then just divide that by 3. Okay, that's the pullback you need from the high. That's where you would look to add some shares. Okay, that's a discount right there. Now again, the lower this number is, so if this goes down to 2, you're being more strict. If this goes up to 4, you probably don't want to go above that number, but you're being a little bit more loose with your money. Okay? Now, the important part here, again, is just to get a discount while the markets are pulling back. But last point that I want to make, and I'll do it with Rata here on the example, you want to keep it simple. This is not something that should take you more than 10 minutes. It applies to large caps too, right? But basically for RADA, if we look at this, we want to keep it simple. So let's say the stock ran up from 3 to 15. We're rounding these numbers. Okay, rounding these numbers. So automatically we're going to just run this basic math formula. 15 minus 3 equals 12. Okay, so 12, again, this is the last part. We need to do one more step. Divided by 3 is $4. That means for RADA, I should be willing to buy it if it pulls $4 off the high. Okay? Now, this is actually pretty straightforward, right? It went up to 1480. Obviously, if the stock has a chart, by the way, that is just one big spike, one crazy day, and it didn't stay up there, you shouldn't be using that price, right? You want to use a price that we've tapped at least once or twice, okay? So 1480 minus 4, that puts us 1080, and as you can see, RADA, all I would do from this point on, whatever platform you use, even if you don't use a fancy platform and you just want to set a basic price alert, There are a bunch of free platforms out there that just let you set price alerts as it is. Okay, so all I'm doing in Thinkorswim, and again, whatever platform you're using, I just click on 1080 roughly right here. I can change it afterwards. Go to create alert, at or below, right? Because we want it to drop. So at or below, not at or above. And then we do 1080. All right, and I just put buy shares. Whatever note you need to make, however many shares, whatever. If you want to do a preset order, that's fine. I actually don't really want to recommend that. If you use a good till canceled order, that's a little bit more risky, because if the stock has bad news or if you're not watching it closely, that could be problematic. You could be buying on the earlier end of a sell-off and put yourself in a really tough spot. Okay, so I would set the price alert. That way you could actually sit down, right? Because we all have 9 to 5s. We all have something going on in our life that's taking time away. I don't have a 9 to 5, but I got a family, right? I don't have all the day to sit in front of a computer. So we set that alert. We wait for it to hit, then we go back, take a seat, see if we want to buy the stock still, see if anything's changed, pull the trigger, buy those shares. Okay, now there's one last part to this, and it's actually pretty simple. So we talked there about fundamentals. I'm not going to get into the technicals too much. Bowser Report's all based off of fundamentals, and while I do trade in my free time, this is a pretty advanced aspect. So I put this in here for anybody who understands that, right? Pull back to the 20 weekly EMA, usually a good place to buy as well. But for now, we're just going to go over fundamentals. Okay. But last part of this, we talked about setting price alerts already. Kind of skipped that here in the little presentation. But basically, you just don't buy all at once. And I'm really hoping that a lot of you guys stuck around till the end of the video, because this is arguably also one of the more important aspects. The way that this works is that if we get that 30% pull, right? It's not a 30% pullback off the highs, right? But it's a 30% drop relative to its range, right? So we get the low to the high, take that, we cut it up in a third, and if it drops down a third, right, then we buy that dip. Now, the reason why that's so important is because I use a rule called the 30% rule, meaning that if, and technically it's the 33% rule, but technically if a stock hits that mark, then you buy 30% of your typical position size. So normally, if I'm buying, for example, we can go back to this LSYN chart. If I normally buy 1,000 shares of a stock that trades at this price, or even 100 shares, right? Let's go even smaller. If I normally buy 100 shares of LSYN, or that's at least my current position, what I'm going to do is I'm going to buy 30 shares when it hits that mark. So all I do, right, and this is the easier way to look at it, I identify the market drop. I say, all right, markets are dropping. What names do I want to buy? Pick my favorites, and then do the math and find that price point. So I found that price point on LSYN. I think we said it was around like 450, 480, something like that. But let's just say it's 450 and we're being a little bit more strict, right? We want to pull back further. And let's say it's even 420, right? And we want to be even more strict than that. All I'm doing is I'm setting the alert here. So I'm right clicking my chart, set alert, at or below, all right? And then I'm just gonna put a note that says buy 30 shares, create, and then when that triggers, it triggers and I buy it. I think I accidentally put, oh no, it is under 420 right now. That's why it just triggered. But basically when that alert goes off, you just buy 1/3 of your usual size and you keep doing that. So if you still like this stock, and it drops another $1.10, whatever we said it was. So if it comes down to 310 from here, okay, then you can buy another 30 shares. You do have to limit yourself and not oversize into one position, obviously, but that's the 30% rule, okay? Call it whatever you want. Use a slightly different number. It's the same aspect of risk management and buying into plays. Because, and you know, this is where people get screwed. If I'm trying to time the markets and I buy a dip and it keeps on dipping, I'm in a really tough spot, right? If I'm not trying to time the markets and I'm just trying to buy a dip from LSYN and I buy the dip, but then the markets still keep on dipping, I'm not trying to time them, I just wanted to buy some, but I buy a full size, again, I have put myself in a very bad spot. It's not worth trying to nail the low. It is worth gradually sizing in over time and building up a position to build your wealth in the future. Okay? So again, we'll roll through this real fast. What defines a dip? High volatility, right? So you can just wait for the VIX to get above 30. All right? A lot of you guys probably are unfamiliar with that, but it's simple, right? If the ticker VIX goes above $30, usually the markets are dropping pretty quickly. Okay? Pick your favorite stocks, make a list, just 1 to 3. You don't need to buy all of them. You know, I do this for large caps too. I did this for Costco. I did this for, a couple of the banks during the COVID crash. I just sold some JP Morgan today at 151 from 93 during the drop. So do this with large caps, small caps, whatever you prefer. Okay? Define that good price and then just set the alert. After you do the math a couple of times, it's just like this. It's very quick. Okay? You don't even need to go to a calculator or anything. You just run the whole numbers and then keep it simple. Okay? And lastly, buy a small size. That's it. You don't need to load the boat. You're just looking to gradually size in, and then eventually you'll see that you actually do have a decent position size, right? So that's the 30% rule. That's the best strategy that we use for buying the dip. Obviously, we still recommend to stick to whatever game plan that you currently have for your investments, but to each their own, right? This has worked extremely well for us, and we hope it works for you guys too. Okay? If you're not subscribed to the channel, please be sure to do so. If you are, check out the Bowser Report newsletter. I'm sure you will make some money off some of our picks and more than likely learn a few things. All right. So thank you so much, guys. Have a good one, and green screens to you.